So here's the big puzzle for all of us in 2026. For more than a decade, the US market was pretty much unbeatable. But now the tide is really turning. We're seeing this great global rebalancing with money moving in ways we just haven't seen in years. The question is, how do you make sense of all this chaos? Well, it turns out there might be a clock ticking behind it all.
Okay, let's just start with the sheer scale of this thing. The US stock market makes up a whopping two-thirds of the entire global market cap. But the US economy? It's only about a quarter of global GDP. So you can see why, with that much concentration, even tiny shifts of capital feel like an earthquake for the rest of the world. And this isn't something that just happened overnight. For 12 of the last 16 years, betting on America was the winning play. It was basically the only game in town. But that long, comfortable ride came to a screeching halt last year. This isn't just a small dip. It's a major change in who's leading the market.
And hey, don't just take my word for it. The numbers are screaming it. Just look at where the money is going. Sure, global stocks are getting inflows, but a jaw-dropping $34 billion fled U.S. funds in January alone. And where did it go? You guessed it, straight into international and emerging markets, which are pulling in record amounts. Money is definitely on the move. Okay, so that leads to the big question, right? Is all this just random noise, or is there a method to the madness? Let's take a look at how the pros track these flows, because it turns out this isn't madness at all. It's part of a much bigger and surprisingly predictable cycle. Now, this isn't just some gut feeling or guesswork. You've got firms like EPFR that are tracking the daily, weekly, and monthly moves of over $55 trillion in assets. It's like having a real-time GPS for the world's financial circulatory system, showing exactly where cash is flowing to, and maybe even more importantly, where it's flowing from. And when you dig into that data, you find something really interesting. The money isn't just hopping from one country to another, it's rotating, and pretty aggressively into some very specific sectors. Just look at the year-to-date inflows for energy and materials as a percentage of their assets under management. I mean, that growth is huge. But look at financials. It's just hemorrhaging cash. This is a clear, targeted shift.
All right, so to really get why this is all happening, we need to talk about the one thing that powers everything in the markets: liquidity. Think of it as the lifeblood of the financial system. Its ebbs and flows are what really dictate where all this capital ends up.
So here's a really crucial point. There are two types of liquidity. Market liquidity is all about how easy it is to sell something without tanking the price. But funding liquidity, that's about whether you have the actual cash or credit to even make the trade. One is about access, the other is about ability. And this is where it gets dangerous. A small shock hits the market, and suddenly funding gets tight for the big players. So they have to start selling stuff to raise cash. That selling pushes prices down, which scares away buyers, so market liquidity dries up. That causes volatility to spike, which makes the lenders demand more cash up front, which tightens funding even more. You see how that works? It's this nasty spiral that can just freeze markets solid. But what if I told you there's a way to predict these huge shifts in liquidity? What if this wasn't random at all? This brings us to a really incredible framework from Michael Howell over at Cross Border Capital. He argues that these massive global flows, well, they follow a clock. It all comes down to this really simple but powerful idea from Howell himself. All money has to be somewhere. If it's out there being spent on new factories, creating jobs, building AI data centers, the real economy, then that same money can't also be in financial markets pushing up stock prices. It's a simple idea, but it perfectly explains why a booming economy doesn't always mean a booming market. And this is what he calls the global liquidity cycle. The key thing here is that its rhythm isn't random. It's actually anchored to a real-world event, the average time it takes for global debt to mature and need refinancing. This creates a pulse, a predictable rhythm of about 65 months, that's a little over 5 years, that dictates when the whole global system needs a fresh shot of cash. Okay, so this is where it gets really useful. This cycle breaks down into 4 clear phases. It starts with phase 1, rebound. That's when things like tech stocks do great. According to Howell, that's China right now. Then you get phase 2, calm, good for commodities and financials, which is where Europe is. Phase 3 is speculation. This is late in the game, a bit frothy when energy does well. And according to this map, that's exactly where the US is today. And phase 4? Well, that's turbulence. All right, that's the theory, but does it actually work in the real world? Let's put this liquidity map to the test and see if it lines up with that chaotic market data we were just looking at. So, if we look at the map, it puts the US squarely in phase 3, speculation. The party's still going, yeah, but the smart money is probably starting to check their watches and look for the door. So, what does phase 3 tell us should be happening? It says it's time to start trimming back on your broad stock holdings. And it predicts that money is going to rotate into those classic late cycle winners, things like energy, commodities, and utilities. Starting to sound familiar? It absolutely should, because this is the exact same data we saw earlier. The theory predicted a rotation into things like energy and materials, and the real-world data shows massive inflows into energy and materials. It's a perfect match. The framework doesn't just explain why money is leaving the US, it pinpoints exactly where it's going. It's like a cheat code for a market that otherwise feels totally unpredictable. Okay, so now that we have this incredibly powerful framework, what does it all mean for you? What are the key takeaways for navigating what's left of 2026?
First up, the era of just buy the US market and call it a day is over. Diversification is officially back and it's essential. Second, with the US late in the cycle, you can't just buy anything. Selectivity matters more than ever. Focus on quality. And lastly, follow the themes. The money trail is clear. Capital is flowing toward tangible, real-world assets that do well late in the game, like energy, minerals, and infrastructure.
And that leaves us with one last, kind of chilling thought. Howell's cycle has been amazingly accurate at explaining right now, but it also predicts what's coming next. And after phase 3, speculation, comes phase 4, turbulence, a period defined by volatility where defensive plays and cash become king. The real question is, what does that mean for your portfolio? Are you ready for what comes next?